Greetings, people. Right, so today we are doing our two notes to the balance sheet, which the first one it's our beautiful ordinary share capital there, together with our retained income. So, before anything else, we always want to determine what we call our FY. What is our FY? It's basically our financial year. When does it begin? When does it end? So, as we read there, it's Activity 1 Stony Ltd. The information below was extracted from the accounting records of Stony Ltd. on 28 February 2021, meaning that's the financial year end. So, if it ends on 28 February 2021, you first want to look what's the month after February, then it's March, but you don't use this year's year, you use last year's year, which is 2020. So the first month of the financial year, it's going to be 1st March 2020. Then from 1st March 2020, it's moving until 28 February 2021. Beautiful. So we're supposed to take into account everything that happens within this time interval. Perfect. So now let us go straight to our information and let's hear what's happening. So they said to us, prepare the following notes to the financial statements for the year ended 28 February 2021. Quite easy and perfect. So with your ordinary share capital, let us first define what it is. So ordinary share capital, it's basically what we use to acquire our capital simply by trading our shares. So you start a business, you're the only individual owner. You decide that, you know what, I need more capital into this business. So you need your business to first be scalable, then you can offer a stake into your business to potential investors. So it's more about investors. And then with retained income, the most important word for retained income is just retain there. It's the income that we decide to retain into the business, possibly for unforeseen circumstances. Perfect. So, right, information, which is A, balances. So they said the balances for 2021 were extracted from the accounting records before the adjustments and additional information were taken into account. Okay, these are our adjustments. We had the beginnings adjustments for both your retained income and your ordinary share capital. So you want to quickly take those two amounts and put them where they should be placed. And by the look of things, they were already placed beautifully there for us. So those were our both of our opening balances for both your ordinary share capital and your retained income. So now the problem comes lapper side. So this now needs deep intervening. So we first start with the ordinary share capital. So let us go straight to our share capital and hear what's happening. So they sent to us share capital and dividends. So meaning this information, it's based on your ordinary share capital together with your dividends. So dividends are going to affect your retained income, right? And your shares are going to affect your ordinary share capital. And if there's any repurchase shares, then you should know that it's going to affect both your ordinary share capital together with your retained income. So let's get straight to it. So they said Stony Ltd has an authorized share capital of 400,000 shares. This is how much shares they are willing to offer. It's not necessarily what they offered at the beginning. It's what they are willing to offer. So now let us go do that and see what's happening. Let's go to the second bullet. Second bullet, 300,000 shares were issued on 1st March 2020. And that is the beginning shares. They've already recorded for us. So that is complete. Okay. Third bullet, 20,000 shares were repurchased on October 2020 from the estate of a deceased shareholder. Beautiful. So once it's repurchased, it basically means that we are buying back our shares, but there's a payment that we have to make, right? So you want to quickly come there and record your repurchase shares. You bracket them because now somebody is giving up their ownership. Then you want to come there and write your repurchased shares. So the one thing that is missing here, it's what we call our ASP, average share price. That is our ASP. So how do we usually find our ASP? Simple. This is how we find our ASP there. ASP is equals to your amount divided by your number of shares. Perfect. So it would have been easy had they told us an amount there that is going to affect the repurchase shares. But now we have to find it by ourselves. So what do we do? There we have our amount this side, and there we have our shares this side. So you just take your amount of 1,275,000. Then you want to divide it with your beautiful 300,000 shares. So let's quickly do that inside our calculator. 1,275,000 divide by 300,000 shares. Then you will get your 4.25 cents, and that is your ASP. So now you will say at 4.25 cents. Beautiful. And you already know it's still repurchase shares, people. So even there's an amount that we're going to pay towards these shares via our ordinary share capital. So now you will say 20,000, you multiply with your ASP. Then you quickly want to multiply that. Then you're getting how much? 85,000. And that's the amount of the repurchase. And then we go to the next bullet. They said 40,000 shares were issued on 28 February 2021. These shareholders do not qualify for final dividend. That's the most important one there. So they're saying to us 40,000 shares that were issued on 28 February, which is the last day of the financial year, together with your last financial month of the financial year. So since we issued, it means we have given up 40,000 shares of ownership into our company in exchange for the money. So we want to quickly go there and record the 40,000. So the 40,000, we're not bracketing it because these shares are being issued. So you want to quickly go there and record that as your additional shares. But at what price? That's what we don't know. So by the look of things, we were given figures extracted from the financial records on 28 February 2021. And they said money received from the issue of new shares. And there we have the new shares. So meaning this is the total money that we have received. So you can quickly sub your amount beautifully there as 220,000. Then that's how you know that you're cooking. So how would you know the price per share of these shares issued? It's simple. You just take your 220,000, you divide it by your 40,000. So 220,000 divided by 40,000, and I'm going to get my beautiful R5.50. So it means these shares that were sold at R5.50 per share. This is how much they are worth. Beautiful. So now what is left? It's for us to calculate our end balances. Beautiful. So here, there's not much of complications like other question papers, but we will be going through that as time goes by. So you want to see your 300,000 minus your 20,000 plus your 40,000. Beautiful. Just like that. So let us quickly calculate it. It's a minus. Oh, apologies, people. It's a minus, then it's a plus. So 300,000 shares plus you minus your 20,000 shares. You add with your 40,000 shares, and you will get your beautiful 320,000 shares. So these are the total issued shares. And then with your amount, you still want to do the same thing. You add, you minus, then you add. So we minus there, and we want to add that. So it will be 1,275,000 minus your 85,000 plus your 220,000. Then you immediately get your 1,410,000. Simple and easy. So with this amount, it's the one that is going to affect your balance sheet under your equity section. And obviously, it's going to occupy the ordinary share capital spot right under your equity section in your balance sheet. And even if you get this amount wrong, take it as it is, because nobody's unsure in exams, but I believe people should be sure always. So this amount, even if it's wrong, take it as it is, straight to your balance sheet. You will score yourself a bonus mark. The main aim is for us to get marks. We are not supposed to lose marks. Beautiful. Then let's get straight to our retained income. So retained income, the first thing that you must check for your retained income, it's your balance at the beginning, and by the look of things, it was already given. The next thing that is going to affect your retained income, it's your net profit after tax. Beautiful. So let us go find out about our net profit after tax. Where is it? Beauty. Information D. There it is. They said income tax was calculated at 28% of the net profit. So meaning the income tax which was paid, it was 28% of the net profit before tax. So meaning the net profit before tax, it's at 100%. And the net profit after tax, that is going to be after we deduct the 28% from the 100%. So you have to see 100% minus 28%, then automatically you will get your 72%. And then of course your income tax, that is going to be 28%. So amongst the three, which are we looking for? We are looking for the net profit after tax. Perfect. But what do we have amongst the three? When you go to your figures extracted from the financial records, you have your income tax paid, which is 112,000. So we do have the income tax, sorry. We do have the income tax. That's the one that we have. So the income tax, they said it's 112,000. Beautiful. Then you still want to apply the method which we were all taught in the lower grades. Given times what you want over what you have. What were we given? We were given 112,000. What do we want? We are looking for the net after tax. And what is your net after tax? It's 72. You quickly want to substitute the 72 there. And then, what do you have? I have the 28%. There you substitute the 28%. So you want to quickly punch that inside your calculator. 112,000 multiplied by 72, divide by 28. Then you're getting your 288,000. So that's the simplest way of getting to your answer there. Perfect. And the second method of getting this right, it's quite easy and simple. You can just reverse your calculations. So it's 112,000. You multiply that by 100 over the 28. So let's try it. 112,000 multiplied by 100. You divide that by 28. Oh, sorry. 112,000 multiplied by 100 divided by 28. Then you will get your 400,000. thousand. So bear in mind, this is your 100%. This is your 100%, people. And we know that 100%, it represents our net profit before tax. So in order for you to determine your net profit after tax, you have to take your 100%, which is the net profit before tax, you minus your 28%, which is your income tax. So you minus that. Let me quickly punch that. Then you will get your 288,000. Then that's how you see that you've proven your answers correct. So remember, you must always indicate your workings in order for you to score maximum marks. So you can use this first method. You can write those workings first, or you can write these workings. So I prefer the traditional way. I'm just going to write my 400,000. I minus my 112,000. You close your brackets. Then instantly you will get your 288,000. Beautiful, just like that. Now, what is next? The next part is going to be your repurchased shares. So, of course, you know the repurchased shares which were repurchased from you. You obviously know that is 20,000. Right. So, based on your repurchased shares, we have to go look up the information there. And there we have 120,000 as part of our payment for repurchased shares. That's the total, people. Meaning your ordinary share capital together with your retained income, they exist in this amount, right? So there's your ordinary share capital. It already exists in there. So to get your repurchase shares, because now we've already written 20,000, there are two ways of actually doing this. So the first way, which is the simplest way, you can just say 120,000. You minus your 85,000. Then you will get your beautiful 35,000. That is going to affect your repurchase shares, but under your retained income. Beautiful. But let's do it the other way around. The way we are used to it. So we obviously know that, okay, not all of us, but this beautiful triangle was taught it in grade 12 back in high school. So you have CFS, OSC, which is your ordinary share capital. CFS is cash flow statement. Then you also have your retained income. So remember 120,000. This is the total amount of money that we have paid towards our repurchase shares. So you can just say 120,000. You divide it by your 20,000. You will get your $6. That is your cash flow statement. Beautiful. This is the amount that we use usually when we're completing our cash flow statement. And then with our ordinary share capital, we just calculated it from up there, and it was 425 cents earlier on to the video. Then with our ordinary share capital, we have 425 cents. So to get your retained income, it's quite easy. You say $6 minus 425 cents. Let us quickly do that. 6 minus 4, 4.25. Then you get your beautiful 1.75. So meaning the 1.75, it's going to affect your retained income in terms of your repurchase shares. You get there, you multiply your 20,000 shares by your 1.75. So now let us check if we're going to get the same 35,000. So 20,000 multiplied by 1.75. And still, I'm getting my beautiful 35,000. You want to bracket that because you are making payments to the shareholder who's considered not to no longer be a shareholder into the business. Perfect. So now let us get to our dividends. So there are two types of dividends, people. Two types. The first is your interim dividend. The second is your final dividend. So let me quickly write my financial year there. March, April, May, June, July, August, September, October, November, December, January, February. So with your two types of dividends, you obviously know you have your interim and you have your final dividends. These dividends, they can be quite tricky, but let me assure you, this one, it's paid within the 6 months period. So whatever shares existed within the 6 months period, those shares are liable for the interim. It's something you should know, right? So when you quickly do your calculations, you want to count the first 6 months. 1, 2, 3, 4, 5, 6. So you have 6 months there. On top there, you want to write your interim. Then you go check what was happening. 300,000 first March. So automatically, these 300,000 which were issued at the beginning, they're going to qualify for interim. 20,000, they were repurchased. But don't forget, when they got repurchased in October, these 20,000 shares, they existed this side. So already they are included there, right? Don't try to minus them because they still existed for the whole 6 month period. So be careful with that one. It can be quite tricky sometimes. All right. So now let's go to our next bullet. They said 40,000 on 28 February. So these 40,000 shares that were issued on 28 February. So already we can see that it's only 300,000 shares which are going to qualify for interim. And then they said to us an interim dividend of 10 cents per share was paid on 28 February. It was paid, people. It was paid. So you get there, you say 300,000, you multiply with your 0.10 cents, right? Then you quickly do that, you punch that inside your calculator, you get your beautiful 30,000. Simple and easy, just like that, right? And then when it comes to your final dividend, be extra careful here, people. So 300,000 shares, they will qualify for final dividend. But don't forget, inside your 300,000 shares, 20,000 shares were already included. But since they were repurchased on October, these shares, they are not liable to qualify for the final dividend in February. And the other shares of 40,000, since they were issued on the last day of the financial year, they also cannot qualify for final dividend. And on top of that, these shares, they also told us that these shares do not qualify for final dividend, right? So you only have to say 300,000 minus the 20,000 of the repurchase shares. You can't minus 40,000 because they were not yet included inside these 30,000, inside these 300,000 shares. Only 20,000 was included, right? So you take your 300,000, you minus 20,000, you get your beautiful 280,000. These are the shares which were issued. No, not issued, but they qualify for final dividend. They qualify for final dividend. Now, let's go check what are they saying to us. They said a final dividend of 20 cents per share was declared, not paid. It was declared. So if it was declared, then you already know this is already a liability, meaning this is payable. So this one, it has to go straight under your current liabilities because it's payable within next year's financial year. So you immediately take your 280,000 shares, you multiply with your 0.20 cents. And when you calculate that, you will get your beautiful 56,000. Then you add these two all together, then you will get your 86,000 there. This 86,000, these are the shares on ordinary shares. These are the dividends on ordinary shares, right? But don't forget, we are paying our shareholders there. So meaning the money, it's leaving the business. And then just as we know, You obviously know that we're going to say your balance at the beginning. You add your net profit after tax. You minus your repurchase shares. You minus your dividends on ordinary shares. Then you will get your balance at the end. So on this one, it's a plus. This one, it's a minus. Then a minus. Then you get your equals to that. So we will say 28,900 plus 288,000. You minus your 35,000. And you minus again your 86,000. Then you will instantly get your 195,900. And this, it's going to go straight to your balance sheet under the equity section. And you obviously know you're going to write it as your retained income. And just like that, you've cooked your whole paper and you were successful. Right, people? Catch you on the next one. President of the world.